Hello, everyone. Welcome to the new Barbarians Podcast. This is episode number 4. I'm joined by Mark Connors and our producer, Christopher Rosa. Today is Sunday, January 19th, 2025, the day before Trump is inaugurated, and this podcast will drop on that day, January 20th, 2025. In this episode, we will discuss the Trump trade and how we design portfolios to take advantage of strategic and tactical outlooks in the short and long term, starting with our Q1 2025 tactical ETF portfolio. Before we get into that, we will actually give a backdrop of what happened over the last week and where we're looking over the short term. Last time we spoke, we were in the middle of what was the beginning of a sell-off, and we were actually seeing crypto do okay when the rest of the markets were going down. And then the following Monday, we saw a huge sell-off in Asia, which we attribute to a deleveraging. And we subsequently saw crypto and Bitcoin sell off all the way down to below 90. And subsequently in the week, we had a CPI print that was slightly softer than expected, and the markets have rebounded. And altcoins are flying, and everyone's happy again.
Phil, what day was our last podcast?
Our last
recorded on the 10th, dropped it on the 13th.
So we were, wow. So that has been, you're right. That whole arc of, thanks, Chris, for that. What we just said was what has happened since we last dropped it has been a lot in the markets.
It's been a wild ride.
Wow. So what do you think was, if you were to pick a point on it that, you set up the call by saying that there's a tug of war between the realities of economic data like debt, dollar, and growth versus the promise of Trump trades from policy and the stick of tariffs. What did you pull out as one of the highlights of the past, over those past 9 days?
Well, first of all, I was panicking on Monday, and it was nice to actually catch up with you all and sort of just look ahead and say, well, Trump is going to be inaugurated the following Monday, which is now tomorrow. And so, yeah, I was happy to just hold on and not panic too much, even though that was, for someone like me, a pretty scary day. But, we did see some good news for markets with the CPI print. And, in the meantime, I took my macroeconomic, region-specific, sector and risk premia alpha capture outlook that I gathered from Wall Street firms and the buy-side firms, and started building a portfolio to take advantage of those outlooks.
Okay, and that's what you talked a little bit about that last week with your outlooks, right? That we discussed, and then you started putting it into practice.
That is correct. And
nice.
So by the time this podcast drops, we will have also published the outlooks on our blog, and we'll get into that a little bit later in this. But in the meantime, we'll just do a quick recap of what those outlooks were.
So, and as we said, we're going to, as Bill just said, we're going to go focus on outlooks in Trump. And before we do that, maybe can I go over some of that top-down aspects of the economic realities that have to be addressed, even as Trump, as we speak, is tweeting, right? This is now 11 a.m. on Sunday the 19th, and Trump is already saying he's going to do an executive order allowing TikTok as long as they give a slice to the U.S. He wants to own a portion of TikTok, sign an executive order, because I guess the rumor was that TikTok was going to go black in the U.S. today. So, Bill, the wild ride, that's what I guess we should probably put, a bucking bronco on our cover of this episode, because that's where we are. But Chris, can you cue up that that dollar 10-year, because before Bill goes into his portfolio, which he's used to help navigate this crazy economic and Trump riddled week, I just want to go through stuff that I think we're going to be seeing throughout the year that he has to address with folks like Scott Bessent, who just had his nomination hearing last week. So here on the top left, you're looking at the 10-year in gray, which obviously rose heavily as the Fed started raising rates in 22. It's a 5-year look back, and it's stabilized. And the whole point here is, and these are big nuggets of ideas, moving the 10-year, the Fed does not have control over it. The market does. And what happened was the Fed started cutting rates in September of last year, and the 10-year actually rose over 115 basis points. We're reviewing that. The dollar rose with it. The lower chart shows you how closely tied they are, the dollar and the 10-year. And back to a crazy week, on that weaker than expected CPI print, modestly so, I wouldn't hang my hat on it, the 10-year dropped. And the dollar, a little less so. The dollar's been a little bit more persistent. So these are things we're going to continually go back to, because a strong dollar means that it's bad for U.S. companies. It's also destabilizing for other countries and may require the U.S. to come in and stabilize foreign currencies. That means more Fed balance sheet, that means debasement, and that's asset inflation. So does the Fed control the front end? We don't. Yes. Does it control the long end? No. So, Bill, one thing that why alts went bananas was because people thought that maybe Fed rate cuts will help risk assets. We don't think a Fed rate cut will help risk assets. We have other reasons. So that's more the top-down one. Back to you on what you see from your tools and trade with the Trump trade in 2024.
Cool. So as we do navigate what is a historically volatile situation, especially given the last week with Trump and his inauguration coming up tomorrow, Chris, could you pull up some of the charts that describe what we talked about last week, with starting with the GDP forecast from the street? Cool. So, to recap, I think if you just look across the street, GDP forecasts are pretty normal, 2.5%. So, it's good growth, and that's also a good backdrop for the rest of the economy. And then we had expected returns by risk by asset classes. And so, we're out looking for U.S. large caps, U.S. small caps, emerging markets, a lot of risky equities to do okay. And then, we don't really like bonds, high yields. And we see, volatility pretty high everywhere. But, again, we expect the stock market to return about 10%. And then below that, we have factor premia and conviction levels. So going across value, we expect that to perform well. And, there's decent conviction around that across the street. Momentum, we expect to continue outperforming and to outperform in Q1 in particular. And then quality will also be a good place to be this year, especially in a volatile market. And, in the worst case, we do have problems. If there's asset bubble sell-offs, you want to own quality stocks and value stocks and maybe less momentum. But as I said, I think we'll continue to play like we had in 2024 through Q1. And then, Chris, can you pull up the next chart?
Hey, Bill, I'm going to just, as you're doing that, the focus on momentum is huge. And as far as the Trump trade's concerned, one thing that just popped up, I bet after that weaker than expected CPI number that you mentioned, I bet saw inflows into their spot ETF. That's BlackRock's spot ETF that was launched a little over a year ago on January 11th with the other 10. Saw $500 million of inflows on one day after that CPI print. And FBTC Fidelities on the next day saw 300 million. That might be the biggest day for both. I'm not sure, but both those funds saw outflows earlier in the week. Maybe why we had that shot through to 89,000 on Bitcoin on that Asian deleveraging on Monday the 13th. But what a difference over the week. And that's why Bitcoin went up 15% on a full average true range in just 5 days. So I just want to talk about momentum. It's happening, and we're not even open yet on Monday. Markets are closed. So we're not even going to see the follow through on this, I think, until Tuesday. I just want to pop that in on the Bitcoin flow side. Thanks.
Yes, thank you. And yet another data-driven insight. I think one thing we're going to definitely keep an eye on are flows across these asset classes. But in particular, it's interesting to see how equity-based investing in things like Bitcoin is driving markets. And it's not, MicroStrategy anymore, as we've discussed in the past, but owning IBIT, and then I'm going to get to other ETFs where you can get crypto exposure after, as we discuss the Trump trade. But just to cap things off with, or to, finish the discussion around the macro backdrop, this slide actually shows us inflation expectations across the street are relatively normal, and kind of in line with GDP. And then, we have another cool chart. I should actually also say that all of these charts were generated directly by Claude, which is very cool. We're actually working on trying to make them a little bit easier to understand. For example, that second chart doesn't really make a whole lot of sense because it's missing labels, so we'll skip that. But the third one, which is, this spider web chart, or I'm not even sure what we call them, just shows us the same thing. We're going to see value, momentum, and quality performing well. And, I think that this is the intersection between conviction and expected returns across those risk premia. And then regionally, I think this chart's showing us PE ratios, which are historically high, but also, as we've discussed previously, we expect earnings to go up, so price appreciation should be a little bit more in line with history. And then in sectors, we expect technology to continue outperforming, consumer discretionary to do well, and then industrials. I think, again, these are all consistent with the Trump trade. And to really answer your question about what do we do in a crazy week like that is, you go back to this type of data and you look at what the street is saying and why did they say it. And, it's still true a week later, despite all the craziness in the market. So, I feel very comfortable designing my portfolio around these top-down outlooks.
Nice. Yeah, you have to have your core thesis set because, the orange man hasn't even entered 1600 full through the inauguration, and he's already, as we said, talked about executive orders. And I won't, spoiler alert, I won't take what you want to talk about later, but he also dropped something Friday that was unexpected on markets in the digital asset realm. So there's a lot of noise, but what you and Chris and Harmonic's team has done is to parameterize a lot of this using LLMs and your decades in the quant research and markets is critical because you have to have source data, you have to have attributed, and you have to be able to view it in a way that's actionable and back tested. Because we still think the reality of market dynamics like growth, employment, and debt have to be dealt with, and promises don't get you there. Anyway, so thanks for that.
And yeah, I'm not sure exactly what you were referring to, but there is a new Trump meme coin that was dropped that, may not be.
I didn't hear about it. I didn't hear about it. Can you tell us?
It may not be the right investment for this audience to make, but yet it is another data point among many.
Yeah.
And I don't know, Chris, do you have any thoughts on this sector of the market?
Yeah, I mean, look at this. Look at this screenshot we're sharing. 24 hours, a 15,000% increase in the first 24 hours of this meme coin being dropped. I mean, can't get that in the equity markets, can you?
No,
Not investment advice, and you cannot. Maybe in the pink sheets, something that maybe folks in the boiler room, Vin Diesel back in the day was pumping out to his clients.
I don't even think you can get that in the boiler room.
Well, so we talked about Trump trade a little bit. We want to go back to that later because I think the whole meme coin dynamic that now, Trump has gone on to is something to touch on later because it's a unique animal in the digital asset area, but it does actually reflect demand for something that I think is still worth talking about with everyone here, but not right now. Bill, do you want to keep going, and then I'll go back to kind of what I saw as broader market Trump trades? Or do you want to go back to your portfolio?
No, let's go over that in a little more detail after you finish off the backdrop.
Okay, good. So yeah, that makes sense. So before Bill goes into his bottoms up, I'm going to continue the top down. Maybe touch on that table we have, Chris, on the digital assets, equities, bonds, and commodities. The first graph we showed of 10-year and dollar are broad-based. I mean, the currency market's the most actively traded, trillions of dollars a day. That's why we talk about it. Every asset is denominated in currency. So when the dollar gets strong, other currencies get weak, and it really impacts businesses. That's why we talk about it. But let's talk about what people understand, which is equities, bonds, and commodities. So I think the two columns to look at are the 3-month column and the 1 year. Bitcoin's up 55% in the last 3 months, most of that on the Trump trade, moving from the mid 70s, low 70s up above, hitting 108, now 105. So the majority of the last 1 year came because of Trump. Trump is supposedly Bitcoin and crypto, two different asset classes, supportive. He said he's going to announce a Bitcoin strategic reserve. He has the ability to do that. There's a mechanism called the Exchange Stabilization Fund, and he can create an executive order and compel Scott Bessent to adopt Bitcoin into that fund, which is used to stabilize markets. For example, in 2008, when the dollar was strong and markets were and currencies were failing, the Treasury offered swap lines, and we bought dollars in. It went from $80 billion to $800 billion. So we pushed assets in there to support the demand for the dollar. We think Trump has stated that, or we think the ESF is a mechanism for Trump to meet his promise of creating a Bitcoin strategic reserve, similar to oil, and what gold is in the gold that backs, or that is in our strategic reserve as well. So that's a long-winded way of saying Bitcoin got tailwind for that. Now look at the Nikkei. The Japanese yen is weakened against the dollar. Flows are leaving, one of the world's largest economies, and it's down on the year, the last 3 months, and obviously the last 5 days. So there's a reality of a strong dollar, and that's what Trump has to take care of. That's got to come down. And then the other loser, obviously, are bonds. The 7 to 10 year bond down 2.6% versus slightly up on the last year. So that's a major one. Very high level. Winners and losers with the Trump trade. but the dollar's got to come down for more winners. And maybe, Chris, if you could flow to that next graph, which would be a good handoff to what the work that you and Bill have done on a bottoms-up standpoint. Let's just look at first the loser, pharma. When you have Kennedy coming in with a pretty anti-pharma approach, Lilly and even AAA rated Johnson & Johnson are both down the last 3 months, bringing Johnson's 1 year return lower and more than cutting in half Lilly's. But there are winners, drill baby drill. You have Chevron, who's got an acquisition of Hess that hopefully will go through with a new FTC commissioner. You have Citibank, who's been left for dead, up 26%, more than a third of their 1 year gains coming from the Trump trade. And then obviously Coinbase, over a third of their gains in the last year coming since the Trump trade. So winners and losers being made. Now, Bill, back to you, because as we said, there's a lot of noise. There's going to be more noise. The Orange Man, as we said, loves Twitter or X now. So we're going to be hearing a lot of things. What are you doing to try to make it more signal than noise in your portfolio?
So again, I just stick with that Wall Street alpha capture outlook that I put together. And, I should say that I do a lot of work to get comfortable with that. I think I uploaded, 100 different publicly available reports across the street in the buy side. I collect notes, throughout the quarter that, there were probably 200 reports that I sort of read with LLMs, and then I synthesize them, and then we actually shared the synthesis of those alpha capture outlooks. It's a little bit harder to get your hands on outlooks for risk premia, so kind of in the quant space, I always want to construct a portfolio that first looks at the macroeconomy, then at regions and countries, then at sectors within them, and then risk premia outlooks across each of those dimensions. And then ideally, I can come up with a portfolio of, say, 10 or 12 ETFs that express that whole opinion. And so I go long, short, and I'll typically have a bias for where I think the market is going. So as we said, we think the market will go up 10%. And so I do have a long bias. And, last week I was a little bit freaked out. So, that's when you can, make mistakes and allow your emotions to get involved. So I'm sticking with it. There's a long bias to the portfolio. And, thankfully I had a little more confidence after the market bounced. And one thing that I added was crypto exposure. And rather than just look at Bitcoin, I'm actually including altcoins as well. So Chris, can you pull up the charts of the actual ETF recommendations I'm making? And so I'm going to have to get the names, but these are the tickers for the portfolio recommendation. And you can see the big one there, BITB. That is the actual crypto ETF. So that's, long mostly Bitcoin and then Ethereum being the two biggest. And then it has much smaller positions in all the rest of the altcoins. So I like that because it covers the whole sector. And I think it does capture some of the volatile upside of the altcoins. And then long artificial intelligence, that's what the first one is. And then, you can see the portfolio weights on the left-hand side. So, I'll just rattle them off for people that are just listening. So, 12% in an artificial intelligence ETF, 8% in robotics and AI, so 20% AI. Another 15% in tech software, 20% in the crypto fund, another 5% in the blockchain ETF that takes positions in the companies that are the publicly traded companies that have exposure across the sector. So all in all, there's like 25% of a crypto allocation. And then a little bit safer, 15% in a value ETF that's targeting U.S. cash flows. We expect, free cash flows to do well in that risk premium factor. India, so we're taking an emerging markets bet of 15%, and then the China this is on. Then we get to the shorts. So we're shorting the China consumer, 6%, 4% China clean tech. So that's kind of a double down, given Trump and the way a lot of sentiment is moving around clean energy and things like that. Problem with that ETF is it wasn't liquid enough to take a bigger position. So we're spreading out some of the exposure in China.
And how would you measure liquidity, Bill? What's for the folks to get an idea of that?
Good question. So I actually, whenever I prepare my tables, and this was a bad recommendation that I got through several iterations with the LLMs, which I love them, but after I've spent many hours correcting their mistakes, it was recommending this ETF that had, I don't know, like a few million or 1 million in average daily volume per day. So you can use that as a proxy, as well as the AUM and some other factors to determine, whether or not you can establish a large position or not. And I think it was originally 10%. So if we were going to have $100 million portfolio, you would need to trade 10 million. And if it's got like 1 million ADV, it would take you 10 days. And you would presumably move the market even if.
And ADV is average days volume?
Yes. Sorry.
And and that's market value, like of it, not shares, right?
Correct. Yes.
Okay. Yeah, that's a big deal, especially when we have a market like this. And if you try to sell and you need 10 days to sell a position, it could be tough.
Oh, yes. That is, I wasn't even really thinking about the days it would take to sell and get out. And of course, the portfolio is constructed with risk management guidelines. So that would be one of them. If you have a drawdown in a specific position, you want to be able to sell out. And
I'm belaboring the point here on this because it's not just a thought. You're not just getting ideas from an LLM. You're using your years in the risk and quant seat to understand what it's like to not just identify, but to manage the portfolio through the realities of a 9:30 to 4 o'clock market.
Yes, and so thank you for pointing that out. My goal is to make this portfolio as realistic as possible. So, and I think in particular on the risk management side, you want to be able to protect yourself in the event that things go awry, and you need to get out of the position. You don't want to get stuck holding something illiquid. And then the last two recommendations were short Eurozone equities. And that one wasn't as concentrated in a risk premia. I think that there are ways to look at Europe, but that was just an easier way to balance the portfolio for beta, as well as short Eurozone, and then short the S&P 500. So we're going to short the overall market and then take long positions and all the concentrations we like.
Okay.
And I think that about summarizes it. And like I said, the crypto investments are kind of new to me, but they're certainly new to my recommendations with these quarterly outlooks that I make. And Chris has a lot to do with that, being our crypto researcher. So I can kind of let him elaborate a bit more on crypto space and altcoins?
Yeah, so where Mark and Bill shine in the equity space and the Wall Street background, I focus on cryptocurrency and trying to come up with cryptocurrency analytics and constructing a portfolio in that space. And where it's helped working with Mark and Bill is as crypto investors, you see the market move for what seems to be no reason. But now looking at it from a traditional finance background, it really helps understand why some of these things are happening. Looking back to the deleveraging on Monday and then the jobs report coming out subsequently thereafter in the CPI, you could see that the crypto market responds in kind with a big down day on Monday and then a rebound into the end of the week. So that's working with these two has really helped me start to combine strategies and understand that the crypto market is much more intertwined to the equity space than we might think. One thing I want to touch on is flows into Bitcoin and what we call the flippening into the alt season. So if you see this chart here, we can see money first flows into Bitcoin, and we can see that's been happening, especially this week, right? With Mark mentioning record inflows into ETF Bitcoin. So I anticipate over the next week we're going to continue to see Bitcoin and XRP continue to have its day through Trump's inauguration. Then I think quickly thereafter that money is going to start to flow to Ethereum and larger caps, and they're going to start to have their day. And then the last cycle of this alt season, as we call it, is into these smaller cap and meme coins, and you can really start to see this in these charts, looking back over through the 2017 cycle and also through the 2021 cycle. Bitcoin had its day first, and then lagging into the alts. So Bitcoin in candles and all of the altcoins, everything minus Bitcoin in the blue line. So you can really start to see this flow of institutional money. Well, first retail money back in the day, but now institutional money flowing into Bitcoin and then into these altcoins thereafter. Looking to today, the altcoins have not had their due yet. So we anticipate over the next couple of weeks Bitcoin to really have its day. XRP's been in the news recently, and we're going to start to see some flows thereafter into the altcoin season. And lastly, just looking at this chart here, this is Ethereum in green and all altcoins minus Bitcoin and Ethereum in blue. So you can see they've been ticking up quite slowly. And when that money starts to flow from Bitcoin into these altcoins, we will start to see that altcoin seasoning take shape.
Got it. So to date, Bitcoin dominance is like 56% or so, 57%, Chris. And the thing that I've noticed, and something that my former analyst at 3IQ and I, weren't the only people, but it seemed like Ethereum was like the middle child and lost a lot of attention, and it was a bookended market with Bitcoin and Solana gaining most of the price and attention from market participants. Is that something that you expect to change, or has it already changed?
Yeah, I mean, we've seen Solana tick up significantly over this past week. I think they're up 40% over this last week. So, Ethereum and Solana are definitely some L1s and L2s that people really, really tend towards. So I think that will certainly continue.
Yeah.
XRP, I think, is going to have its day too. I mean, they're up 500% since November. And they're expecting a continued rise going forward too. XRP has been a struggling case since it was launched. It's kind of hung out at 50 cents for a long time, and I think the SEC played a big part in tamping it down. And now that we have a new government, pro crypto government coming in, and a new SEC chair, I think you're going to see that change as well.
Great. Would this be a good time to kind of give context? We start talking about, Bitcoin. There's Bitcoin, then there's crypto, which obviously, I'm focus in my business practice solely on Bitcoin, and appreciate the merits of actively trading other alts. But I put out definitely a buyer beware for anything other than Bitcoin, from my standpoint. But I know at Harmonica, you guys are looking at everything to actively trade and risk manage. So after that little commercial that I just laid out there, can you roll out the top 10 digital assets?
Yep.
Because as we look through this, and this is a good, this is mostly, I think, from TradingView. I pulled this, cobbled together. They do a good job of giving you the whole market cap. So just like in equities, we all have known to appreciate that the Magnificent Seven have driven about 65% of gains over the past 2 years. The top 5 names, I think, are 28% of all S&P market cap. 1% of the names are over 25% of the market cap. That's quite a concentration. And the top 10 names, I think, are 38% of the entire market cap. We even have more concentration in digital assets. Yes, so stay on this one right here. Thanks. So this is putting in context the growth of digital assets. Bitcoin is the fastest to $1 trillion asset in the history of markets. And what I like about this graph is if you're looking to invest, outside of private debt, which is now, the newest shiny alt on the Wall Street block that people are gobbling up with the help of folks like Apollo. You have the old gold, tech equities, and then the commodities, other commodities like basically silver, Bitcoin, a digital asset, and Saudi Aramco. Now, we're not going to show it, but when we blow this up to include the top 25 names, 25 assets, there are only 2 that are either not a commodity, not an ETF, or not US. And they are Taiwan Semi and Tencent. It shows you how dominant the US is in the either ownership or financialization of assets. So that's traditional assets. And digital assets are already creeping in. Now let's look at the next context piece, if you could, which is, so this is what I was talking about. Top 25 names, only 2 are non-US. So the reason why 6% of the population controls 45% of all financial assets is because of Wall Street, it's because of Silicon Valley, and now with Trump's policy, we believe it's going to continue with digital assets and the adoption. But let's land the plane here on that last chart, which shows the top 10 coins. This is the universe of the top 10 digital assets. And Bitcoin dominance, we say, 2.1 trillion out of 3.7 trillion is about 57%. One asset. You don't have that in equities. There's tremendous concentration. That's why Bitcoin's core to every asset. When you do the top 10, it goes to 85% of all assets, all the meme coins, everything you can think of. 85% are only 10 coins, and they've been very fluid. That includes stablecoins, which is probably going to be the biggest, next to Bitcoin legislation and potential inclusion as a strategic reserve. The number one driver of digital assets in 25 will be the adoption of stablecoins by banks if that goes through, if banks are allowed to custody digital assets. So, Chris, do we have the ability to eventually put this in our show notes when we drop this on Inauguration Day?
Absolutely. Yep.
Awesome. Okay, good. So again, bottom up, we like to show you what the scope of the markets are, or the context of the markets. And it is a concentrated market, but there's a lot of movement. Solana's, as Chris said, has moved a lot. It's moved 40%, I think, maybe over the weekend. since Trump dropped his new coin on Friday at 9:40, while unsuspecting revelers at the crypto ball in D.C. didn't even know that they should have bought it at $16 when it went up to 60. So that's
Mark, could you speak to what advantage banks have by adopting the stablecoin?
So let's look at the number, is it 5 coin here, Tether. So Tether is a non-US based, I don't know if it's Bermuda or Bahamas, I forget the legal entity where it's domiciled, but it has 138 billion of market cap. And it trades at close to $1 because what it is it is a digital asset that it issues when someone comes in to buy a digital asset, a Tether stablecoin. Tether then goes out purportedly and buys $1 of T-bills and puts them in a custody so that they are backed. Now, T-bills aren't buying $1. T-bills are a security that carries an interest rate, close to 4.5%. Tether then has accumulated that interest. They have not passed it on to the majority of their holders because that makes it a security, and securities can't be, it would put them in crosshairs of the SEC. Now, so apparently they do it for some customers, but the point is, you now are providing a service to people. You're allowing them to have digital dollars as a bank, whether it be Bank of New York or Chase Chase Retail or JP Morgan. And you can do what Wall Street does best. And you can take a slice of that income from the Treasury for the home team and let the rest flow out. That business does not exist today. So it would be a new business line with a built-in margin. And God forbid it leads to other businesses. Like, what are people using digital dollars for? Maybe to buy other digital assets. So now it leads to a whole new ecosystem that the banks are fully locked out of.
Yeah, what a powerful tool.
It's a gateway drug, and it's not hard. And it also gives the Treasury new buyers. If you expand the stablecoin audience, they're going to need T-bills, the world's best collateral, most liquid collateral in TradFi, to back these. So if it goes to trillions of dollars, that's now trillions of new buyers for assets that didn't exist before Trump took office. Talk about a victory lap he could take to try to take the pressure off of the growing debt load. So it's a total win-win. And although, as you know, I love to see the Bitcoin legislation, I'd like to see banks be able to custody and trade first to get those rails going. Stablecoins are the best animal to do that, and then let the good times happen with allowing people to actually hold Bitcoin and custody Bitcoin as opposed to the ETF. Yeah, this is, as you can tell, I'm pretty bulled up. I think it's one way because of the incentive structure.
Yeah, and something that we've been researching at Harmonic is real world assets, and BlackRock has been a leader in this as well. And they've been taking that concept and bringing it to the blockchain with their token called Bildl, and there's another one, Ondel, where they're tokenizing T-bills on the blockchain. I think it's, to your point, it's just a gateway drug to tokenize debt and credit and T-bills and put it on the blockchain. It's going to be a very big sector, we anticipate.
Yeah, are they using Ethereum on those treasuries?
Yeah. BlackRock, actually, I was researching this over the weekend. They built a layer 2 ecosystem on top of Ethereum, and they launched a coin called Bildl.
Okay.
And they're onboarding, they're buying T-bills, and it's and tokenizing that and bringing it to the blockchain. You can't buy those as a retail right now, but there are competitors. Like I mentioned, there's a company called Ondo, Ondo. You can actively trade that on Coinbase, and I think they're up 20% this week. Yeah, closer to 30%. So it's a big sector that we anticipate a lot of money flowing into.
Got it. Yeah, I know the asset managers have been moving first because of the different restrictions that they are not held to or regulations that banks are. Because Franklin Templeton also did a money market fund on chain as well last year sometime.
Yep.
Cool. All right. So what's up next here before we land the plane and let the inauguration happen?
Okay, so I think for the last part, we were just going to talk a bit about methodology and the tools that we use to make our recommended investments and to invest our own capital. And so we've touched on this a bit, but I think what we're going to do is give a high-level overview of using LLMs in the investment process. LLM stands for large language model, so that's ChatGPT. I actually use multiple LLMs extensively, and I have published research about the actual methodology I use, the strengths and weaknesses of the different models. But I subscribe to them because otherwise these freemium models kick you out, and I use them so much that it easily is worth the cost. But I use ChatGPT, Claude, and I should say in order: Claude first, then ChatGPT. I use Google Gemini extensively now. Sometimes I use Microsoft Copilot, and I think that's all. But effectively, I'll use any of them at any given time for things that I think that they're particularly useful for. So, for example, I like Claude for its ideation. When I ask it to help me design a portfolio, it just does a much better job than a ChatGPT. Google Gemini does a pretty good job as well, but it has some weaknesses in the way it ingests, documents in particular. Although I did find a new tool that Google has, and I'll get to that in a minute. But basically I'm using LLMs to summarize, synthesize, and ultimately quantify outlooks across expected returns and sentiment from experts. So again, that's why I call it an alpha capture portfolio. I gather outlooks and sentiment around assets, regions, sectors, and risk premia. And then I want to make my investments on the intersection of those different things. So bonds have risk premia. You can have value bonds. You can have value bonds in Asia. And you can have value bonds in Asian industrial companies. So, each of these things in the quant space are called dimensions, and it's helpful to slice and dice your portfolio along these different dimensions because you can very succinctly get the exposures that you want. So that example I just gave would be, find me a bond that gives me those exposures, and then, through a screening process, you can find one and add them to your portfolio.
I imagine the MicroStrategy bonds would come up maybe as a momentum bond, which is an unusual pairing because of the price action. Maybe not in the last month, but over the last 12 months.
Certainly, I would think that those meet the criteria of momentum bonds.
As far as like your point about even bonds have different dimensions, people think it's just a monolithic bucket, but it's not.
No doubt. And you can even have the same thing with government bonds, commodities. Any asset really should have these different quantitative risk premia associated with them. They're a little harder to observe in other assets. And equity space, it's pretty easy. They're typically screens of stocks with certain attributes. So you look at their accounting information and come up with measures for value, growth, etc. And so this quarter, I used Gemini Advanced for the first time, which was very, very useful because it can actually go out and find reports and read websites and summarize them. So I just asked it to go out and find me all of the reports that it could, published publicly among the Wall Street banks and buy side. The huge advantage there being if you don't have a prime brokerage relationship or a subscription to different research venues, it can actually find you whatever the banks are saying publicly, which is, typically a CIO view, and it may not be, you know, individual stock specific equity research, but it'll give you a look from the top of a bank and its outlooks.
Got it.
So I use that, for that first phase, which was really just give me a synthesis of this alpha capture outlook across the globe. And then a new tool that I just started using, which is Google's Notebook LM. That allows you to process like hundreds of notes, PDFs. It can watch and summarize videos and tons of different media. But in particular for myself, I collect, it looked like about 100 different notes over the last quarter. So I get these from various sources, including email and, LinkedIn posts from different CIOs. If I see something that I think is interesting, will be useful. In particular, if it's discussing risk premia in the quant space, I kind of grab these notes, and I had Google's Notebook LM summarize all of those. So then I merge everything together into a single report, which, ultimately is based on like 200 different documents. I start iteratively building a portfolio with Claude and ChatGPT. And, this time I started to keep a roadmap because I need to systematize this and start using APIs, which are application interfaces, meaning I want to ultimately use Python scripts to execute a lot of this workflow, but I need to keep a roadmap to give to the machine.
So, Bill, when you're pulling in those LinkedIn notes and emails from CIOs into Google Notes, and so you say that there are 200 of them and they summarize it, does that summary then help weight the factors and parameters in the risk premia that you're looking for? Is that the goal, is to look at it as what the consensus is, and either you go long or short the consensus, or what the...
I think that is correct, yes. So in that first phase with Google Gemini Advanced, it did a great job of going out and getting all of these reports and summarizing them, but it didn't do as good of a job at expressing sentiment around all of these things. And when a CIO or someone actually sends out a note throughout the quarter, a lot of times they express more conviction and they'll contextualize their outlooks a little bit better. So yes, that is exactly what I would say I did. I took that first phase, which would be all of the outlooks globally, and then I wanted to quantify a sentiment around all of these signals. And that ultimately translates into the first version of my portfolio, which will be a conviction-based long-short ETF portfolio. And so, as I said, I counted this time, I went through about 10 updates, and, it's basically like working with a first-year analyst. They do a decent job the first time, and then you have to say, okay, go back and change this, change that. Sometimes it forgets what I liked in the first version when it comes back with the second version. And, like I said, 10 times, these were definitely pretty big mistakes that I wouldn't want to make. This is actually a report that I'm going to publish, and it takes several hours to go back and forth with an LLM and actually review this output and make sure that it's consistent with the original. For example, the ChatGPT first version was, incredibly broad. It was like go long and short, like markets, buy the S&P 500. I was like, oh yeah, I like beta because I'm going long, but that was definitely not the right recommendation. And so I told it to go back to the drawing board a few times. One cool thing you can do after you've done these 10 things is you can upload that and use what's called a prompt engineering tool to say, boil down all these 10 different back and forth updates that I needed to prompt the LLM, and try and boil it down into like one script.
Mm-hmm.
So over time, I'm trying to improve these tools and learn from these mistakes and control for the output and make sure that it stays on track. So, for example, I went back and forth 10 times with Claude, and then I basically used that as a prompt for GPT to double check. Of course, I didn't like that, so I had to go back and forth another 4 or 5 times with ChatGPT. Ultimately, I'm going to, use multiple LLMs through several of these processes and compare their outputs. So the idea is you give it the same information, the same report and the same prompt, you would expect the same answer. Nope, you get different answers. So then what's kind of cool about that is you can merge them and say, which one had a better opinion, which is going to be based on its training data, I suppose. But for me, it's really just comparing 2 different ideas. So now I have 2 analysts that are, sort of having a bake-off for the best ideas to get into the final portfolio. And then, all the way at the end with this process, I caught Claude recommending an ETF, as I mentioned earlier, that didn't meet liquidity and risk management requirements. And
that was because it wasn't proposed as an option, or because the information, it was proposed, but they decided to underweight it, liquidity minimums or things like that.
So, for whatever reason, it didn't listen. That was definitely a requirement in the initial prompt. And, this does also get to very specific things that are perhaps technical in nature. Like sometimes they forget their original instructions, and original instructions were definitely to have liquidity, a liquidity requirement, and there are minimum liquidity requirements. But as you move through this process, eventually it can forget specific things because it'll lose what's called
context window.
So the context window is not large enough to keep track of all of this information. And so that's when you do get into the need for having a process where you generate a report, stop using that LLM. You can still use that tool, but you'll want to start over and say, okay, here's the report and the requirements, but you don't want to continue giving it prompts.
Got it.
Which can be very inconvenient if, your 100-page document is actually full of artifacts that you need.
But what you just said is probably not a first principles, but it's a best practices for certain outcomes. What you just said is you got to end the thread and then redo it effectively, right? In that LLM.
Yes, I learned the hard way. Yeah. And another problem you can do is if you keep going and going and going with an LLM, eventually you'll kill it. So I've frozen these things and then kept asking it to generate that last piece of analysis, and it'll say, yes, sorry that it's taking so long, and it'll just keep saying that even though it's clearly dead and frozen. And Chris, if you can just pull up that last spreadsheet version of my ETF portfolio, I'll illustrate this a little bit more.
This one, Bill?
Actually, it's a Google sheet. I think it would be the last link I sent you.
That had it was the table with all the figures in it? I got it here. Yep. By the way, we're over an hour, so we should start to land the plane here soon.
Yeah.
Cool. So, just quickly, you can see the tabs. So basically I have a Claude portfolio, I have a ChatGPT portfolio, and then a correlation matrix. And maybe that's, the most colorful graph that looks kind of cool. But the reason I bring that up is because not only do I look at correlations and quantitative measures of the ETFs and their own price history, I start looking at the constituents. And, one other question I ask the LLM is, make sure that there isn't too much overlap. If you recommend two indices, a lot of times they'll have the same stocks, and you don't want to take concentrated bets in anything without knowing it. And ultimately, you want to aggregate all of the constituents for each of these. ETFs are just portfolios themselves. So, 10 portfolios means 10 times N stocks. And, you want to look at them and think about your portfolio as being ultimately a portfolio of all of these individual stocks with weights in each ETF, long, short. And that's, kind of where the quantitative analysis really takes off. And in the future, we'll probably get more sophisticated. But for the time being, it's just simply a portfolio of 10 or 12 ETFs that you want to manage long, short. And then this is also a good time to bring up regarding Notebook LM. Next week, we hope to have a guest visitor named Tharsis Souza. He's a former colleague of mine who is a product specialist in the equities space. So he develops technology for quant equity researchers. And he actually just published an open source book called Taming LLMs. And I guess the reason why he started this was because he was building a process around the Notebook LM to, basically ingest a bunch of research that he was, reading or that he would prefer to listen to. So Notebook LM actually allows you to upload a bunch of research and then convert it into a podcast, which I thought was interesting. It basically creates two different AI robots that talk to each other and explain something to you after you give it all of this information. And through struggling with that process, Tharsis ended up writing this book. And thankfully, I've caught up with him several times in my journey because he explained a lot of things that were burning me, and now I have upgraded and implemented in my process.
Mm-hmm. Nice. Look forward to that. Yeah, I've read some of his work. He's obviously not just studied, but was able to share back how best to do that along the lines what you and Chris are doing through your blog, making sense of these tools, which are phenomenal. Well, thanks. I think that's close to a wrap for us. Here, you're listening to this on Monday, Inauguration Day. We recorded this on the 19th, as Bill said at the top of the hour. You can reach Bill. Do you want to share where you can get your research that you and Chris have?
Sure. I think the best place to find our blogs would be our Substack, which is the Harmonic Insights Substack. You can find it in the notes. And we're also on Smart Karma, which is, one of our partners. And we would love for people to start looking at that as well. But I think the easiest place to go is Substack.
Got it. Perfect. All right. And you can also find my work on Substack as well. Market commentary for TradFi and budding Bitcoiners. Top down, bottom up work about the still emergent opportunity in Bitcoin. It's Bitcoin first, as Fidelity says, and Bitcoin and crypto, different animals, different services, and definitely get curious. And as Bill's laid out, using AI may be a good way to accelerate your knowledge base in the area. Enjoy, everybody. Any last comments for the crowd here, Bill or Chris?
As always, please like, subscribe, comment. It helps our videos out a lot.
And no guest appearance from Buster. He actually has been passed out on the couch throughout the podcast today.
Overdose on Alpo, no doubt. All right. Cheers, everybody.
Great.
Thanks, guys.
Have a nice holiday.
Thank you.